We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Hunter, Contrarian Macro Strategist with 50 years experience and also has a quarterly letter by subscription. David, thanks for joining me today.
Yeah, hi, Tom. It's great to be on. I haven't seen you in a while.
I know it's always seems like such a long time sometimes between, revisiting with some guests, but, there's always a lot to talk about, especially it seems like, things are almost ramping up and there's news to talk about that's more frequent as time goes on. Of course, right now is no exception, but I'd like to start by kind of framing what we've seen over the past couple of weeks. We saw this drawdown, the sell-off in a lot of the equity markets. And of course, we're speaking this morning on August 14th, which the CPI number came out as well. So why don't we start by thinking a little bit about, or chatting a little bit about how maybe we need a sell-off like we saw over the last week for the Fed to start to change its mind. Is that something that the Fed is really looking for at this point to really start to cut rates and for the market to act upon how they think the Fed is going to react?
Yeah, actually, I don't think the Fed is really tuned into the market that much. For a long time, going back to April of 2022, when Bill Dudley had put out a speech about the market being part of financial conditions, and unless we got the market down a lot, we weren't going to, the Fed wasn't going to be tightening financial conditions to the degree they needed to. From that point forward, Powell was really hyper focused on the market from a negative standpoint, saying every time it lifted its head, you could see his minions come out and try to talk it down. It was so obvious and transparent that that's what they were doing, and they did that all through the balance of 22. He had his head handed to him in the fourth quarter of 2022 because they kept trying that, and the market kept going ever higher. That was, the market bottomed out in October 2022. He continued into the first quarter of 2023, and then since then he's kind of backed off of that and realized, our jawboning isn't working; it's making us look silly, and I think he realized that anyway. And they stopped focusing that way. They've been pretty clear for, I think, most of Powell's reign that he does not want to be part of the Fed put strategy, where we saw that all through the previous reign, where every time the market dipped, out came the Fed to prop it up. He was very clear that that was no longer their strategy, that they weren't going to do that. And I think he's been true to his word ever since. They are focused, as he says over and over, on their dual mandate, employment and inflation. And for a long time, obviously, because they were slow to recognize the inflation risks and slow to respond. So they kind of got criticized quite a bit for that. And so they've been fighting that inflation war pretty hard, partially because it took a while, it was sticky. But now I think they're overstaying their welcome on inflation. They're still worried about a breakout of inflation when it's clear it's trending down and I think is ultimately heading towards deflation. And they used the jobs numbers every month to kind of determine whether they needed to worry about the economy. Well, jobs is a lagging indicator, so I don't think it's the greatest thing to focus on if you're looking to lead the economy and have policy react before things happen. But that's basically their mandate is jobs and inflation. So I think they've stuck to that, and I think he's been very sincere and transparent that that's what they're looking at. The street wants to be skeptical of that and wants to think they have another agenda. I really don't think they do. So if the market, as it did last week, sells off, I don't think they're number one. They're not rooting it on like they were. I don't think, but I don't think they're unhappy to see the market, back off from its, speculative phase it was in. but I also don't think they feel at all compelled to react to it from an easing perspective. So what you're getting right now, which is they're still pretty measured in what they're talking about in terms of policy. What I think you're getting right now is them saying, and they made the decision in their July meeting, July 31st meeting, that they weren't going to cut and that they were going to wait to September. They gave you some pretty good signs that September is likely to see a cut. I think with the actions of jobs last Friday and maybe a little bit of the animal spirits out there, and a lot of the rhetoric that brought forward from economists, et cetera, you could see a 50 basis point cut, but I don't think it's because of the market. A cut in September. I don't think it's because of the market. I think it's more them recognizing rates have come down. Well, it could be because of the bond market. Rates have come down a lot on the 10-year, for example, or even short rates. And so now they're way behind the curve. They're much more, their policy is much more restrictive than it was, particularly if inflation's trending down. So I think it's more a realization that we have to do some catch up on our rates to get back in line. So you could see 50, I think, in September, but not because they're panicking, not because they think the economy is about to fall off a cliff, not because of the market, really because their policy dictates that they should.
Mhm. David, you're mentioning that the bond market plays an important role there. I think this is a good spot to lay out how you see, what is actually controlling the market and how much real clout the Fed has, how much control they really have over the market. Is it actually the bond market that does a lot more of the work there?
Yeah, I've said for a long time, the bond market tends to lead the Fed. So when everybody's getting all hot and bothered by the fact that they didn't cut in July and starting to talk about the dire consequences of that, I said, first of all, it was going to be a quarter point cut if it was going to happen at all, and which really doesn't change anything a lot. And secondly, the bond market had the 10-year rates had dropped 100 basis points. So the bond market was doing the cutting for the Fed, and that's typical. So it's really, if you really understand what the Fed does, it controls the overnight lending rate where the banks lend one another to square up reserves. So that's how they kind of control the banking system, is through that, or control short rates. They have very little control over long rates. And it's the 10-year that's used to price mortgages, to price loans, et cetera. So it's really that 10-year bond that's far more important in the short run anyway as to what's going on. Ultimately, it's the money coming out of the Fed that will turn a cycle. But in terms of, having an impact on economic activity and stuff, the bond market is far more important in the short run, and it does lead. So what we've seen from the 475 on the 10-year down to we're now 480 or thereabouts. It's been almost 100 basis point drop, and it had dropped 100 basis points before it backed up. So that's having you're seeing mortgage rates come down, seeing loan rates come down. You're going to see some that lead to stimulus, I think, in housing and autos in particular to some degree. It's not off to the races, but it will help at the margin. And the Fed, on the other hand, I think they're behind the curve, and at some point they're going to have to get ahead of the curve, or there's real trouble. But the fact that they chose not to cut in July is not the end of the world. It's not, we keep hearing people talk about hard landing because of that. I think we're still in soft landing territory. We could be in recession already, because when they go back and date it after the fact, the NBER will more often than not, the date that they set when they go back and look at it is before you ever thought it had started. So I wouldn't be surprised if in June or July we started a recession. However, it's either side of zero. We're not deep in recession. We're not strong above zero, but we're in soft landing territory still. I think that will be the narrative that drives the stock market for several more months. So you get a lot of hysteria out on social media and in on CNBC, et cetera, where people kind of add 2 and 2 and get 6 or 8. But really, we're still in that soft landing territory. I think we'll be just fine if they cut in September. Just fine for the market short term if they cut in September. The stock market's going to be looking at the likelihood of a cut in September and discounting that ahead of time as well. So I think we're still in good shape in the market.
So David, maybe this is a good spot to kind of make it explicit about how you see, let's say, specifically the stock market playing out from here. I think let's just focus on that, because you have a melt up theory and then how this ends up kind of playing out here. So let's just stay focused on, let's say, your targets from here in the stock markets and how that plays out, let's say, up until the end of the decade.
Sure. Yeah, let me just step back. And for those that aren't familiar with my call, in October of 2022, I was talking about 6,000 on the S&P. People thought that was nuts. I was saying we're going to have a melt up. And if you remember back to that time, almost all strategists and money managers were bearish and calling for 3,200 on the S&P or 3,000, maybe below 3,000. And the S&P fell to 3,500. I forget the date, but a certain day in October, and reversed that day. And I said, I think we've bottomed and we're heading for new highs, ultimately 6,000 on the S&P. People thought that was crazy, that you can get a dead cat bounce and then go back down, but we're not going anywhere near new highs. It took a while, but it rallied to 4,600, which was short of the 4,800 high, but then corrected back to 4,100. I pretty much called that pullback and then said, we've corrected and it looks like the next run will be to new highs. And that's where we've been. And we've run as high as 56, I think 56.70 intraday. My call now, I raised my target in January on the S&P to 7,000. So as much as 6,000 seemed crazy, and nobody out there had that call when I said 7,000, but I went further and said, it's not going to be a straight line, but I think this cycle is going to end at something 7,000, maybe even higher. And that's my call still. I still believe we're in it. We're in a melt up, and I think what will happen next is the melt up will go parabolic. So we had this sharp correction last week. The S&P I think fell 8.5%, Nasdaq over 10, but it's similar to not as long a correction by any means. This one happened very fast, but it's if you look, it basically is another correction like October of last year that cleansed the system, got everybody bearish again. You'd gotten people, because momentum drives people's psyche, because you had that run from 3,500 to new highs and then up, kept going. People started saying, well, I was skeptical, but I got to get on board. I'm missing too much. So they were on, but they were nervously on. As I say, they were bullish without conviction. My convictions are very high on this bull market call. People were in there because they couldn't afford to not be in, particularly institutions, or just because momentum drives people's viewpoint. But they didn't see, valuations are high. They didn't see the reason why it could go a lot higher. So, they were in, but they were also, the strategists on the street had targets. Some of them were below where the market was, and some for year end 2024, and some were maybe 100 or 200 points higher, but nobody was above 5,600. And we were at 5,670 at the top, a few weeks ago. So when the momentum rolled over and all of a sudden you were down and down sharply in a few days, those people had nothing to hold them on the bullish side because the only reason they were there was a tape. So they quickly went back to the bearish view of, yeah, this market's at the end, and there's real trouble ahead, and the Fed's blowing it, and they had everything thrown at the market, and it bottomed last Monday, in my opinion. Got the Nasdaq and the Russell got down to their 200-day moving averages and turned. The S&P and Dow not quite down there, but they came down pretty hard, and turned. And I think we are in the next leg up, that I think will ultimately be a parabolic leg into a top. So, we could be at my target pre-election. Will we be? I don't know. Will it take longer? I can't say. But because it's going to be a parabolic run here, I think from here, from that low, you can cover a lot of ground in a hurry. It's the final stage, in my opinion, of a 42-year secular bull market. So as you go, the legs get steeper. So if you look at the market in from October 22, we had the leg to 4,600, and then the next leg got from 4,100 to 5,670, steeper. And I think this next leg is going to be even steeper than that. So, almost go vertical. So, again, that's why I say it can cover that much ground in a hurry. It's not normal. You don't see it very often. I think it will be driven by a belief that rates, I think rates can go to 2.5 this year. So we're at 380 or 385. I think we can fall to 2.5 in the next 4 or 5 months. So that will be happening. The dollar's coming down. I think it's finally rolling over, and I think it's going to come down hard. And you'll have a soft landing on the other side to soft landing in terms of the economy, to say, well, if rates are down, earnings are still intact and growing, and the Fed's finally on board, we can see this not only stop at a soft landing and turn around, but then we can start factoring in an extension of the cycle for 25 and 26, and you'll start seeing earnings numbers for those future years go up. And I think then you can discount at a lower rate. You can discount higher earnings, and that's basically what you're gonna do to drive the market up. Now on the pure market side, it becomes technical side becomes FOMO. Because they're not there yet. Right now, people are assuming this thing, the rally we've had this week, will roll over and go back to new lows, or at least retest the lows. So we're not there yet. People aren't jumping on board and saying, oh, the momentum's back, I'm bullish. They're still pretty cautious. But I think once you get this thing up, probably above 5,600, 5,700, they're going to start coming back on board and saying, well, the correction's over, and there's going to be nothing holding them back. They're going to say, well, we're obviously going higher. I got to be on board. So it won't. I don't think it's going to happen in the next 100 points. I think you could rally another 100 points and pull back. I don't think we're going back to the lows. You might go halfway back there or what have you, maybe not even that much. And then I think it's from there that we take off. Short term isn't. It can do any number of different scenarios. That's just one possible scenario. But I do think it's going to take more momentum to pull them back in, because right now we've built that wall of worry back up, and investors are, really saying, I don't think this thing can go a lot higher. I don't want to take the risk for just a little bit more return. I'm getting more defensive. It's going to take the tape doing more than they expected, for them to get excited again. I think once you get to 5,800 or on your way to 6,000, you're going to have more and more people jumping back on the bandwagon.
Mm-hmm. So David, how does once we get to this, let's say 7,000 target, is it just momentum and FOMO that drives that, not necessarily just Fed policy?
Yeah, it's like I said, it's not so much the Fed's going to be printing money, because I think they're focused on rates right now, and they're even slow to change that. I think you're going to go to a point where they'll stop shrinking the balance sheet, but they haven't gotten there yet, and they may not get there for another couple meetings. So I don't think it's new money coming into the system that's driving it. It's institutions changing from a more defensive posture, whether that be bonds, whether that be some money in cash, whether that be more defensive stocks, and moving to a more aggressive posture. One thing, like I said, it's not from here, but I think in the next several hundred points, that's what will start happening. So that, and there's, retail, there's money in cash, there's people that are nervous about the market who will come back into the market. So people are conditioned to think that we need the Fed and the Fed printing money for the market to go up. I, having been in this business 50 years ago, we didn't have, there were plenty of bull markets where the Fed wasn't the big story. There was, the Fed's balance sheet was $875 billion back in October 2008. Today, it got up to $9 trillion this past year, and it's now down $1 trillion or $1.5 trillion from that. So, we've had this huge ramp up in money that did help drive things in the last decade. But markets can move organically. They don't need the Fed. But what the Fed does is when they start cutting, it signals that they do understand that they need to ease, that the tightening cycle is over and that easing is beginning. But the real drive will be FOMO. The real drive will be, as I said, it always needs a fundamental backdrop, because it's not just a matter of chasing the tape. There has to be some rationale, but the rationale tends to follow the momentum. And the rationale will be, as I said, soft landing. The companies are doing a great job cutting costs, and you're seeing rising productivity. So earnings are growing. The quarter-to-quarter earnings are better. We're starting, the look is that we're starting a better earnings cycle, or starting, ramping up again. So you'll have higher earnings, lower rates, Fed ease, and the momentum of the tape. I think all of that will kind of combine to drive the market higher. And as I say, it's kind of nature of where we are in the cycle, the last stage, things really get ramped up.
Mm-hmm. So once we hit these targets, David, what do you expect to happen at that point?
Yeah, so I want to caution, because I have my real target that doesn't get focused on as much, or my real extreme target. I've got the Russell going to 3,300 in that time frame. Same time frame as the S&P. That's almost a 60% move from here, 57% move from here, I think. So the S&P can move 30%. The NASDAQ I've got moving maybe 40 based on my target, and the Russell almost 60. Yeah, it's a huge move from here, but I think it's going to happen. It doesn't have. There's no calendar deadline that says, oh, we got there. It hasn't happened. It's not going to happen. So I could be, I've been wrong before in terms of thinking it happens as fast as it happens. It can get stretched out. But I think the likelihood is that we see those numbers because of the parabolic this year, and maybe pre-election. I just want to caution people, even those targets can be raised. I mean, particularly the S&P. The S&Ps I've got quite a bit lower than the others. I say 7,000. That doesn't mean it can't go to 7,500. Right now, 7,000 I'm comfortable with, but so I'm not saying the bell goes off at these targets, but that's my best guess of where we're going. But they can exceed that. I think I'm pretty comfortable that they're not going to fall short of that. They could, but I'm pretty comfortable with my numbers. Once we get there, whatever the number is, again, no bell goes off. It's not going to be, oh my God, the Fed didn't do this and the market's going down. The catalyst won't be really. I don't think we're going to go down, because it may simply be the market burning itself out, the market finally reaching a crescendo, and then some little thing causes a short sell off, and that leads to a little more and a little more. So you could see, before you blink, the market get to the top and then be down 10% in the next, kind of like last Monday, down last week, be down 10% in a hurry. And it might even be down 20 or 25% in a hurry, and then climb its way back. And, do a half retracement or 2/3 retracement, and then a much bigger leg down. So you're not necessarily going to have a fundamental signal to say it's time, because markets lead fundamentals by a lot, by many months. Markets, the Fed doesn't necessarily trigger anything. So I think it's more likely that it just gets to a level, something turns, and people start reacting to that turn, and then it's down, before you know it, down 20%, and you get a lot more nervous. So I do think the other side of it, the other side of the mountain, I'm predicting an 80% bear market, probably most of it in 2025. But it isn't going to happen in a month or 2 or 3. It's probably going to be stretched out over, 8 to 10 months, something like that. Could take longer, could be shorter, but something like that. Mm-hmm. And it'll be in, I can almost promise you, it's not going to go from peak to trough in a straight line. You're going to have some substantial counter trend rallies, at least one and maybe two.
So, David, from there, what do you think the Fed's reaction is if we get, an 80% drawdown, as you just said?
I think one of the stories, the reason I'm calling for a bust, the bust refers to the economy and the financial system, mm-hmm. and the bear refers to the market that accompanies that, the 80% down. So the Fed will react to both, but particularly the bust. But I think they'll react slowly, because keep in mind, Powell has said for many years now that we're not going back to the policies of the last decade. We are not going to do. He's almost taught. I think he said we don't want to do QE again. We're not going to see, and we're certainly not going to see the magnitude of QE that we saw in 2020 or prior. So he doesn't want to go back to ZIRP, zero interest rate policy. He doesn't want. What he doesn't realize, and that's a sign that he doesn't realize what I think is coming. If I'm right, this is the biggest, fastest downturn we've seen, in the post-World War II era. So bigger than 2007, 8, more, greater magnitude than 2007, 8, bigger obviously than 2020. So it's easy to talk about, well, we're not going to go back there. I guarantee you, if we are getting a free falling system, and it will be weak economy, unemployment maybe to double digits in this country, but accompanied by major bank failures across the world. As I say, the U.S. got hit so hard in 2007, 8, or 2008, 9. We were kind of the big story of 2008, 9 in terms of banking crisis. I think next time it may be centered in Europe. It may be centered in, Europe, Canada, Australia, and some of the places that didn't get hit as hard then will be hit, but we may not be the lead story this time. We meaning the U.S. banks. But it's going to be a worldwide free fall in the banking system, in the financial system. They're going to be slow to react because they won't see the magnitude of it initially, and they're going to and because it's going to require so much more than previous cycles. So it's funny that he's saying we're not going back there. The truth is, before this is over, they're going back there on steroids. I mean, it's going to be bigger than 2008, 9, or the money that was required in 2020. What I think you could see is as much as 20 trillion coming out of the Fed. That's what I think it's going to take to stabilize the system. And of course, every other central bank will be doing similar, proportionally similar. They obviously are different sizes, but so you are going to see, we put out 5 trillion. The balance sheet, Fed's balance sheet expanded by 5 trillion in 2020, 2021. This time we'll see 4 times that is what I'm estimating. So, but to get there, if his mindset right now is we're not even going to see QE again, or we don't want to do QE again, and it's going to go to 4 times what we did, then he's not going to get there in a quick fashion, So he might say, well, reluctantly, I'm going to have to put a couple trillion in because things are blowing up or things don't look quite right. It's going to take him several efforts to get to a right size policy. Mm-hmm. It might be 2, the next time 4, the next time 8, but it's going to take a while before he stabilizes the system. So that's why people don't get it when they say, well, I don't see how your bust can happen, because it has been my forecast long before anybody else. I don't see how your bust can happen. The Fed will react and stop that. They won't allow that to happen. I said, I just laid out the reasons why they're not going to be quick enough to do that. We are, as you know, we are somewhere around 320 trillion in global debt. And we have quadrillions in notional value of derivatives. I call debt the leverage on the financial system and the economy. I call derivatives leverage on the markets. So there are 2 forms of leverage that are at levels that are not, we've never been close to this level going into a recession before. Never. 2008-9 was the closest we were. And we're so far beyond that in terms of leverage today. Leverage not only exacerbates the downturn, leverage on the way up exacerbates the upside or enhances the upside. But when you go down, leverage really exacerbates the downside. Mm-hmm. But it's not just the size of magnitude of the downside. It's the speed at which it happens, because leverage, you kind of hold the dam together, and then all of a sudden when it bursts all at once. So that's why this thing will come at you so fast. And that's why I say we're in the last inning of a long ball game. And there's a big return between now and the end. But when it ends, the disaster is not very far away. So, you can go up 60% in the Russell in a matter of months, and within a year after that be down 80% from there. It's just, or within months after the top be down a lot. So we're in a very risky period. The returns are very high before we get to the end, but the risk is very high as well. So people have to be aware. It's not as simple as, because you're betting, if people listen to me, they're betting on me being right. I can be wrong. This thing could end sooner. So people have to at least know the magnitude of the risk and the speed with which the unwind will happen. Really means you don't want to be late. You can be early and miss some things, but you sure don't want to be late. And unfortunately, the central banks are going to be late.
Mm-hmm. So, David, what happens to inflation if the Fed comes in? Not only the Fed, obviously, as you said, it's not only going to be the Fed reacting at that point, but if we see an injection of $20 trillion to stabilize things, what happens to inflation at that point?
Yeah, with a lag, it's going to be huge. We are going to see an inflation cycle that will blow away the early 80s. I was there, and I started my career in 1973. So I saw the whole ramp up of inflation in the 70s and the early 80s. And what we just came through was nothing like that. I see statistics where people think we're close. This is nothing like what we saw then. This next inflation cycle that will follow the bust will blow away that. I think, and again, these are just seat of the pants guesstimates on my part. But I think by the end of this decade or early next, we could be looking at 25% inflation in the U.S. And it'll be worldwide inflation, so there'll be big numbers around the world. But just the U.S., I think we could be looking at 25% inflation. That means interest rates will be, upwards of 20%. Short rates will be upwards of 20%. And long rates certainly approaching 20% on treasuries. Never mind corporates. That tells you we're in for something we have never seen, and that's combine that with the fact that we have the kind of government debt we have. Just look at the U.S. We have whatever it is, 35 trillion in government debt, in treasury debt, and a lot more other liabilities. But ultimately, 320 trillion in global debt. In the U.S., to try to service our debt right now, we're struggling. It's already exceeded our military budget. It's eating up big chunks of our budget, and that's at 5% with basically 5% cost of service. If it goes to a cost of service that's well above 15%, how do you? I can't draw an equation that comes out with anything reasonable. I mean, and that's with the debt where it is today. When I'm talking about what I'm talking about in terms of a response to the bust, 20 trillion coming out of the Fed, that will probably be matched by 20 trillion out of the Treasury. Mm-hmm. So in other words, they're going to be monetizing new debt to do the QE. And it'll be all kinds of programs. There'll be money handed out everywhere. We saw it in 2020. This will be that on steroids. They'll be doing everything they can, probably to keep pension funds from going bankrupt, to keep Social Security from going bankrupt, to keep there's going to be money coming out of everywhere and going everywhere, and so the Treasury debt will be double what it is now, probably, or close to it. I think global debt will be close to 500 trillion by the end of this, but by say 2026. So you're talking about something that's already way off the rails, going so far beyond this, and then soon having rates ramping up. Now, there's a lag. So the money they print into, and this is one reason why they'll be willing to do it, the money they'll be printing in 2025 will be into a deflationary downturn. So they're not going to be worried about inflation because they're staring them right in the face as deflation, in the form of, banking system failure, et cetera. But, actual deflation in terms of prices. The lag to that, to when it turns into inflation, is usually like 18 months. Lag to the economy is like, 8 or 9 months or less, but the lag to inflation is usually about 18 months. So it's not going to be immediate. You're not going to have inflation in 2026, or it's going to be very low. You'll be coming out of a deflationary environment, so it'll be coming from negative to slightly positive. By 27, it'll probably be moving to mid or high single digit, and then by 28, you're in double digits on your way. From there it just ramps. Mm-hmm. And so, again, it can stretch. I can be off by years, but that's what I kind of estimate. You'll be at your peak in inflation late this decade, meaning 2029, or early next, meaning 2030 or 31. And I think it leads to a total unwind of the Ponzi scheme that we've been in since the Great Depression. So we've been winding up cycles ever since then. So from the 2040s all the way up to today, every cycle's been, more money, more debt, more excesses that had to be answered with more money, more debt. And you just reach a point where it just goes parabolic, just like the market. And once you get there, I mean, obviously we won't be able to fund our debt, service our debt. The other countries out there won't be able to service their debt. And it all collapses unto itself. So, I hate to say this, because it's just putting pieces together and trying to give you some sense of what I see for the 2030s. sometime out, mid 2030s, could be 2033, 4, 5, something like that. But that would be my guess, is in there. I think we get a collapse of the global system. And in the US, you could be looking at 50% plus unemployment, no welfare system, no unemployment benefits, a bankrupt Social Security and Medicare, no Medicaid, basically, or any of these things you might have limited, but nothing close to what you need, and a system in free fall. I mean, it's dire, but I just don't see how you solve the equation that I just described. It doesn't get solved by, as you well know, it doesn't get solved by modern monetary theory. These people who think you can just print more money because you need more, once you go into hyperinflation, more money turns into more inflation very quickly, almost instantaneously, and you get into Weimar Republic problems where, your inflation's causing, putting you farther behind, not farther ahead. So your money printing putting you farther behind, not ahead. So they can print money up through the lower single digits of inflation. After that, the money, the printing press gets shut off, and they'll just, once you lose that option, I mean, we've been blinded by the fact that our standard of living has really been falling for years, for decades. But because of the printing press, we just kept growing the government, right? Our private sector is not in great shape. We've farmed out so much in this country, so much of our industrial base. So much of what we have is a consumer-based economy where it's just based on people buying more stuff and services, where we keep, and you go to the grocery store and yes, those companies earn more money, but they're not earning money by selling more widgets. They're earning more money because they say, well, if we sneak another 10 cents onto the box of cereal, nobody's going to notice. We'll still get the same sales. So earnings keep growing, but really our system's getting hollowed out. And I think once you take the printing press away, you lose all that. You can't, the facade's gone.
Mm-hmm. So David, as a hedge, I think, against a lot of this stuff, metals seem like, the safer place to be for a lot of people. That's how they see them. So, when we're having this much liquidity go into the general stock markets, whether that's the Russell or the Dow or the NASDAQ, from now to the peak as you see it, how do the metals do at that time as well? It seems like there's all kinds of cash going into the other sides. It makes me wonder how the metals are going to do in that time.
Yeah. So talking about, coming back to, I presume you're talking pre-bust, you're talking about now.
Yeah.
Yeah. So the metals, particularly the miners, have disappointed people for a long time here. They just don't seem to get out of their own way while other things are moving. So a lot of people have thrown in Intel, as you well know. You talked to a lot of people in this field. The gold bugs, a lot of them have walked away. They hung on for a long time, and they just, there's still plenty of us out there that believe in gold and silver, but a lot of the investors that were there and thought they were going to be there forever walked away, because it was so disappointing. We had that big run up in the first decade of this century and peaked in 2011, and then particularly in silver, spent the last 15 years in kind of a very disappointing environment. The peak in silver back then was $48. We're $27. The peak in gold is now we're at new highs, right? Or very near we went to new highs this year, and they're about to break out to even higher highs. So gold's done better. The miners have really suffered, and I think you're going to have a big catch up here, partly because of the Fed finally indicating they're going to ease. I think that psychologically makes a big difference. Like I said, people can start looking at a renewed cycle. And so I think you're going to see, I have gold going to 3,000 pre-bust, meaning, probably this year, but it could spill over to first quarter next year. And silver going, which is the bigger call, going to 75. I had said 60 for a long time, and I raised 75, even though it's been kind of lagging. I think you're going to see a big catch up in both of them. My guess is my gold forecast target is probably low. And I don't know if it's low by a couple $100 or low by $500, but I'm sticking 3,000 now, but I think it's conservative. Silver, once you break out to new highs, I think it can really surprise people on the upside. So what I tell people about the miners that have really struggled, they start to go and then they fail. They start to go and then they fail. Their earnings have not supported a move. But even the mining managements can make money if you get those kind of metal moves. Even if you think they aren't very good managements, it's hard to not print money or make money in an environment where your underlying good that you're selling is going up at those levels. So I think we have a big move coming in the miners. I have targets on the ETFs just to give an idea where they can go. GDX I have at 65 and GDXJ at 100, and I think those are conservative numbers. I have SIL going to, which is a silver miner ETF, major silver miner ETF, going to 75. So these are more than doubles in these things, and SILJ, the junior silver, I think can go to 35. And again, I'm guessing, if anything, I'm low on my targets. So, but they're far below those levels now, and they've had trouble sustaining gains. So I understand why people are skeptical. I just think the balance of this year, I think, is going to be a very different environment for them.
So then, what happens in the bust? It's everything is going to get sold to get liquidity. Everybody's going to be trying to move to cash to get out of any asset that's free falling, seemingly. So, are the metals one of the first things to come back after that?
Yes, that's a good question. Yeah, I think you're right. You're right. The basically almost everything will go down. The two things that I tell people in the United States they can probably depend on in the bust are treasuries, because of the government guarantee and rates going down. I believe the 10-year rate could fall to zero in the bust because of all the monetization. The Fed's going to have to be buying every bond they can see. So I think you can see 0 10-year, probably negative short rates, and maybe the 30-year get down to a quarter or a half. So that is one thing that can hold up. And FDIC insured, government agency insured bank accounts up to the insurance limits, 250 in FDIC insured accounts. I have no doubt they're going to, because they have the printing press, they're going to fund the FDIC to whatever is necessary to meet those liabilities. So I'm not worried this cycle about savings accounts that are within the institutional limits. Spread it around so you have those insurance limits if you need to. But everything else, pretty much, you're right, I think will fall. The equity markets, I'm using 80%. Gold and silver. Silver could fall very hard because it's more cyclical. Gold, I would guess, maybe it falls. If the stock market falls 80, maybe gold falls 40 or 50%. Silver could fall the whole amount. I don't know. I don't have targets, but I just think that for sure they're going to fall hard. But then you're right. Once you get 2/3 of the way through the bust, you're going to start seeing. I think gold will be the first thing to move up, because people start understanding all this money is going to create inflation down the road. So you'll get a sense at some point that let's say gold goes to, I'll use my 3,000 target, although I think it's probably low. It could come back to 2,000. It could fall by a third, let's say. I don't think it falls much below that. So if it goes to 3,500, maybe it still comes back here. But from there, to me, I think the end of the decade, when inflation's soaring towards 25%, or is it near there, I think you could be looking at 20,000 gold. So, you've got possibly a tenfold move from the bottom of the bust, from the gold's bottom in the bust to there. And silver, I think, can, who knows where it falls to. Let's say it goes to, if I'm right about, we've got just to make the 75. So you got to get there first to know where it's going to go, but down to, but let's say it goes to 75. It could easily fall back to, in where we are now. And maybe even lower. But from there, I have a target of 500 on silver. When gold is 20,000, silver will be 500. So, you are looking again at something that's a huge move. It might go, that'd be obviously, as we know, in bull markets, silver often outperforms gold by a lot. And I think that's what you'll see in that too. So one might go up tenfold, the other might go up 20-fold. But anyway, so I do think there's a huge cycle after this one, but you can't, as I say, you don't want to be standing on the south rim of the Grand Canyon thinking you can walk straight across. There's that canyon in between. So for those that say, well, I'm a buy and holder, again, physical metals are a different story. People may want to just hold on to them, but in the markets, you probably are not going to feel very good about saying I'm a buy and holder and I'm just going to sit here. I think there's going to be a lot of pain there that these things aren't going to eliminate for you.
So, David, obviously the bond market is seen as a safe trade for a lot of people as well. What happens to the bond market, as well as being a driver, obviously, for behavior at that point too?
Yeah, that's another great question that people need to understand. This is the end of just like I think we're in the last inning of a 42-year secular bull market in stocks. Started in August of 1982. The bond market started its run in 1981. So we're at the very end of a 43-year secular bull market in the bond market. And like I said, I think I'm probably pretty alone out there in saying we're going to go to new lows on rates in this cycle. Everybody thinks what we saw in 2020 was low. I think we do go to, like I said, a 0-10 year. So we got down to 40 or 50 basis points on the 10-year back in 2020. I think we go to a new low this time. We see negative rates in the short rates, which we didn't back then. But from there, and it's not going to happen all at once. It's not going to be quick. Initially you have, deflation. So they're not going to just instantly whip around and start losing you money. But from there to the end of the decade, you'll top out in the bond market, and then you'll have the worst bear market in bonds that you've ever seen. And I do believe, like I said, we'll go from a 0% 10-year to something approaching 20% on the 10-year by the end of the decade. That is devastating to a bondholder. If you make the mistake, and there probably will be some people who put their bonds away and forget they have them even, and then look at them, 7 years later, they're going to go, oh my God, I lost all my money. I had a huge windfall there and it all disappeared. And that's treasuries. Corporates will be, if we get there, you're going to have a lot of failures too. So yeah, bonds, I think because we've been in the secular bull market in bonds, there's been some rough rides along the way, including 2022. However, basically it's been lower highs and higher lows and higher highs all the way up through from the early 80s. That game's over next year. You'll have one more higher high in the bond market, and then it's all bear market from there. So you'll be in a secular bear market that will go in stages. It'll be just like on the way up. You'll have steps. It'll go down and then it'll have a rally and go down and have a rally. But just understand, bonds are, if I were a money manager in the period after the bust, I'd be rolling T-bills. I would not be owning a long bond for the life of me for the rest of the decade. If you roll T-bills, every time you roll, you're going to have higher rates. So initially, you're not gonna have much earnings. But as you roll, by the time you get to the end of the decade, you're gonna have 20 or 25% interest rates on your T-bills, and you'll have started by rolling them when they were low single digits.
Mhm. So do you see, once we get this, should we call it a global bust, once we get to that, let's say to the end of the decade, as you said, do you see the metals as being the only thing that kind of remonetizes these systems after that happens?
Unfortunately, I doubt it. I'm afraid and that is a piece of the scenario that I haven't really built in at all. So there may be in those central banks and those governments that own a lot of gold, because of how far they go, that is an offset to some of this, and they will be able to unwind that to keep the debt serviced. So that is a piece I haven't really thought about, and that is true that will help. There's a lot of countries that don't have gold, so it won't help them.
Mm-hmm.
But and we obviously our vaults are, not what they were, and not relative to our assets. So I'm not sure how that equation works out. It'll certainly help for a little while, and help extend the cycle maybe for a little while. And I think in some of the BRICS, where they're China, for example, where they're making a concerted effort to build gold into their asset structure, they're going to be helped by that. I think, a lot of wild cards as to what happens between now and then, militarily, geopolitically, et cetera. So it's hard to put that in the equation, but it'll help. I'm afraid when the collapse comes, the metals aren't going to help you at all. I think it's going to be a huge deflationary collapse where I think metals get hit hard. I don't know what it does to Bitcoin. I don't think Bitcoin is going to be big enough to be a savior in any way to the system. It may help those individuals somehow, but I think ultimately, if you get a deflationary a deflationary collapse, I don't think the Bitcoin's going to make much difference.
Mm-hmm.
So, my caveat is I don't really follow the cryptos or Bitcoin, but just trying to factor it into the macro, I would think it's unlikely that we're going to see that grow to the size that it makes much of a difference.
Mm-hmm. So you speak about getting your financial house in order as well. What do you think the main steps are to doing that, David?
Yeah, I think first and foremost, we are going to be handed as bad as the bear market is going to be in stocks. There will be a cyclical bull market after that. So it doesn't mean like this peak in the stock market is the end. If you're able to preserve your capital before the bust, if you're able to preserve most of it, you probably aren't going to call perfectly. I'm not, certainly, but you're not going to get out just at the top, or you're not going to, but if you can preserve a chunk of your capital and preserve it through the bust, there's going to be an opportunity on the other side of the bust, because you will have cyclical bull market in the stock market. The first year, maybe the first 2 years, the market can go up. If you're coming from an 80% down, the market can triple or quadruple. It won't get anywhere near back to the high. Let's say 7,000 is the high, and you go down 80%, that's 1,400. You could go up 4 times 1,400 and still be well short of 7,000, right? So, or 3 times, whatever. So there is going to be an opportunity in a broader stock market for a year or two after the bust. Beyond that, though, there's going to be a huge opportunity, and including those first 2 years, but and carrying beyond that, there will be a huge opportunity in commodities, not just gold and silver, but also oil, also copper, also all the metals, because you're going to have an industrial recovery. What's going to happen is if we're printing as much money as I'm talking, and we're doing it around the world, you're going to have this huge demand, because that money will, with a lag, trigger a big demand cycle. I focus on the U.S., but the U.S. is going to be reshoring. The U.S. is going to be focused on rebuilding its industrial. Both parties talk about that. So that's going to be the focus. The consumer is going to be digging out from a disastrous bust. So they're not going to be, shop till you drop anymore. They're just going to be trying to live and get by. And so it's going to be an industrial recovery, unlike what we've seen these last, several cycles. We're going back to the 70s and early 80s, which was an industrial cycle. And what that means is there's going to be a huge demand for commodities, iron ore, steel, everything. And so, and many of those are going to go up tenfold or more. What happens is you ramp up demand because you print money like there's never been money printed. With a lag, that works through the system and creates demand and hyper demand. And we've been rationalizing down commodity capacities for decades because it wasn't a commodity, friendly period. So generally, look at energy. We're discouraging new fields. We're not, because they want to get out of fossil fuels. We're discouraging the expansion of energy, of fossil-based energy. So they're going to be caught with limited capacity to meet the hyped up demand, and it takes a while to build capacity. So it's going to, for several years, you're going to have demand go through the roof and capacity not be enough to meet it. And there's only one thing that can give in that equation, that's price. So price can go, I'm forecasting $500 oil. So you can go from, I think you could get $30 oil in the bus. So you can go from $30 oil to $500 oil in less than a decade. That will be huge for the energy companies, for the oil companies. They'll be printing money. So there'll be lots of opportunities in commodity stocks. It's just there's not going to be the same opportunity that you've had in the indexes. So for all those people who started probably back in the mid 80s, where they started recognizing the baby boom is going to needs to build their retirement assets. So this is going to be a huge opportunity for financial companies to go out there and market financial products. And so, look at the size of BlackRock, for example, today, et cetera. These financial companies have grown tremendously over, a few decades. And a lot of them pushed the idea and pushed their advisors. They said, we can't train, we have this reputation as stockbrokers of, burn and turn them and burn them. You're recommending stocks and you're always recommending stocks that go down, or you're just turning over the portfolio. And next thing they know, their money's gone down. They went to a model where they said, it's time in the market, not timing the market that matters. And basically, rather than picking stocks, most people, you're best just buying an index and you'll capture most of the return. Well, at the same time, we had this huge bull market in bonds where rates came down from 15% to almost zero. That meant PE multiples went from single digits to over 20. So a lot of the move in the stock market and in the indexes was PE multiple expansion, right? You can have the exact opposite thing once you get past the bust, because as interest rates move up, PE multiples get squeezed. So you're going to go from from double digits, high double digits, 20, 25%, 20, 25 PEs back down to single digits. And that means the indexes are going to struggle. So the indexes will not, like I said, in my opinion, not going to get back to the highs we see this year for decades, highs in the indexes. That doesn't mean under the surface there aren't sectors of the market that do very well, like industrials, like commodities, like energy. It just means you can't bet on PE multiple expansion. You can't be in growth stocks. You can't be in utilities. You can't be in things that are hurt by higher interest rates, because it's not just going to be higher interest rates. It's going to be soaring interest rates.
Yeah, I think, thinking about some of these price targets, it's not only, these are nominal returns, right? $500 oil is, an amazing number to think about, but what does $1 buy you at that point, or what does $100 buy you at that point? It's not necessarily the commodities exploding in price, but also the value of the dollar just collapsing.
Yeah,
if we get
you
such an incredible print of money to try to stabilize everything, as you say.
Yeah, definitely. On a real basis, it's not nearly as dramatic. And the other thing to think about in terms of how far these stocks can run and these commodities can run is think about where some of these stocks have run in the last couple in this market cycle from 2009. Look at where Nvidia's gone from. Look where Amazon's come from. Look where Apple's come from. In other words, look where the tech sector's, how much it's appreciated in that time, or even Eli Lilly or things like that, or look at the home builders over the last this whole cycle. So when you get in early in the cycle and you're in the new leadership, it makes a huge difference. If you bet on the same leadership, and one thing my experience pays off. I was in cycles going back to 73. So every single cycle, you had new leadership. So every cycle, the leadership changes. It usually changes during the bear market. The new leadership starts outperforming. The old leadership gets hit very hard because it's so overowned. And it's during that time where you start saying, oh, this stuff's starting to act better. And then in the new bull market, it's that new leadership that matters. It's that takes the lead. And if you can understand that early on, you can make many-fold returns. And so going back to the original question of getting your house in order, the first thing is preserve capital. The second thing is make the right judgments for the next cycle. And the third thing is, start eliminating your debt. Do as much as you can to get debt free, because those that are debt free and have built their wealth are going to have the most flexibility, the most options when things hit the whole system. It's going to be hard for a very large percentage of the population. So those that can, at least do the best they can to get closer to debt free and have a nest egg are going to be that much better off.
Mm-hmm. Well, David, I think that's a perfect place to wrap up. We've covered the gamut, as it were, of the next decade. So tell us a little bit more about where we can find you and the offerings that you have.
Sure. I'm on Twitter every day. So my Twitter handle is at Dave H. Contrarian. So not David, but Dave H. Contrarian. Make sure Contrarian spelled right. There are a lot of fake accounts that spell it wrong. And I'm on there every day. So I get people, and some of these are longtime followers who say, I haven't seen you in a long time. This is the first tweet I've seen from you in a long time. And I'll go, you have to check your settings because you're only seeing my original tweets. I don't do a lot of initiating of tweets anymore, because when I do, I get a shitstorm of people replying and it becomes unwieldy. So I do it once in a while to put out something I think is important. But generally, most of my activity is replies to other people. So if you're not set up in your Twitter for those replies, you're only going to see me post, once every few months or something. And you're missing things. I obviously, when I do these interviews, they're posted on there, and you may not see those either. I also publish a quarterly letter, and it's for both institutional and retail. It was originally an institutional letter that I started writing back in 2000, but it's been available to retail the last few years, last several years. And I have plenty of retail customers clients who say it's very readable and very understandable. So don't be scared off by the fact that it was an institutional letter. If you want information on it, it comes with a cost. You can direct message me, which is that little envelope go to my profile page. There's a little envelope at the top. For those that don't know how to do direct message, just click on that and you can send me a private message. I'll provide you details in terms of costs, what's in the letter, what it's basically about, and how to subscribe if you're interested.
Perfect. David, thanks so much for your time and sharing your views with us today.
Okay, thanks, Tom. Have a good rest of your summer.
Thanks, you too.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.